Have you ever wondered about the long-term potential of Bitcoin? Let's take a journey back to the year 2009, when the world was introduced to a new form of currency, a digital currency that promised to revolutionize our understanding of money. This was Bitcoin, the brainchild of an anonymous individual or group known as Satoshi Nakamoto. Bitcoin was not just a currency, but a technology, a protocol, a network. It was designed to function independently of any central authority, free from the control of governments and banks. The power was put back into the hands of the people, through a decentralized peer-to-peer network. Every transaction, every movement of Bitcoin was to be recorded on a public ledger known as the blockchain. This level of transparency was unheard of in the world of finance, but Bitcoin was more than just a means of exchange. It was and still is a potential store of value. Much like gold, Bitcoin has a limited supply. There will only ever be 21 million Bitcoins in existence. This scarcity, coupled with its decentralized nature, has led many to view it as digital gold, a hedge against inflation and uncertainty. The beauty of Bitcoin lies in its simplicity. All you need is a digital wallet and an internet connection to become part of this global financial revolution. You can send or receive Bitcoin from anywhere in the world at any time with minimal fees. It's a system that's open to everyone, regardless of their location or socioeconomic status. Yet it's not all sunshine and rainbows. Bitcoin has seen its fair share of volatility, and critics often point to its use in illicit activities due to its anonymous nature. Despite these challenges, Bitcoin has proven to be resilient, bouncing back stronger after every downturn. And that's just the tip of the iceberg. Bitcoin has far more to offer than what meets the eye. As we delve deeper into the world of Bitcoin, we'll explore its potential as a long-term investment, the risks involved, and whether it's worth adding to your investment portfolio. So buckle up and let's continue this digital journey. Now, let's dive into the heart of the matter, the long-term potential of Bitcoin. Bitcoin's potential is largely driven by three factors: its finite supply, increasing demand, and its role as a hedge against inflation. Let's unpack these factors a bit more. Firstly, Bitcoin has a limited supply. Only 21 million Bitcoins will ever exist. This scarcity is built into the code of Bitcoin, making it immune to inflation. In contrast to traditional currencies, which central banks can print more of during economic downturns, no one can create more Bitcoin. This finite supply creates a sense of scarcity, which can drive up the value of Bitcoin over time. Secondly, the demand for Bitcoin is on the rise. As more and more people become aware of its potential, the number of people who want to own Bitcoin increases. This is especially true in countries with unstable economies, where people see Bitcoin as a more stable store of value than their own national currency. Moreover, we're seeing a growing number of businesses accepting Bitcoin as a form of payment, further increasing its demand and value. Thirdly, Bitcoin is often seen as a hedge against inflation. This means that when the purchasing power of traditional currencies decreases due to inflation, people turn to Bitcoin to preserve their wealth. This role of Bitcoin has become particularly significant in recent times, with many economies around the world experiencing high levels of inflation. However, it's important to remember that Bitcoin's potential doesn't mean it will definitely go up in value. Like any investment, it carries risks. Its value can be highly volatile, fluctuating wildly in response to market sentiment and global economic conditions. And while its decentralized nature is one of its biggest strengths, it also means there's no central authority to step in if things go wrong. So it's clear that Bitcoin possesses a significant long-term potential, but of course it's not without risks. Like any investment, Bitcoin comes with its own set of risks. Firstly, let's talk about Bitcoin's volatility. It's no secret that Bitcoin's price can swing wildly in a matter of hours, let alone days or weeks. One day you might be celebrating a significant gain, the next, you could be nursing a substantial loss. This roller coaster ride can be a thrill for some, but it's not for the faint-hearted. This volatility stems from various factors, including market speculation, regulatory news, and even technological changes. For instance, if a significant country announces a crackdown on cryptocurrencies, it could negatively impact Bitcoin's price. Conversely, positive news can send prices soaring. The key is to brace yourself for these swings and not let them sway your long-term investment strategy. Next, we have regulatory risks. The legal status of Bitcoin varies from country to country. Some nations have embraced it, while others have outright banned it. Regulatory changes can have a significant impact on your Bitcoin investment. For example, If a country where you hold Bitcoin suddenly bans it, you might find yourself unable to access your investment. It's therefore important to stay informed about the regulatory landscape. Lastly, we can't ignore potential technological issues. Bitcoin is a digital asset that relies on complex technology. While the underlying blockchain technology is robust, it's not invincible. If a significant technological flaw were to be discovered, it could potentially destabilize the entire Bitcoin network. That being said, it's important to remember that every investment comes with risk. The stock market, real estate, even your savings account, they all carry their own unique risks. Bitcoin is no different. Investing in Bitcoin, like any investment, requires research and a clear understanding of the risks involved. It's not something to jump into blindly, it's something to approach with care, knowledge, and a healthy dose of skepticism. Understanding these risks is crucial, but it doesn't mean Bitcoin isn't worth considering. So, is Bitcoin a good long-term investment? Let's delve into this question, shall we? Now, the arguments for and against Bitcoin as a long-term investment are both compelling and complex, much like the cryptocurrency itself. On one hand, Bitcoin has potential rewards that are hard to ignore. Its dramatic price surges over the past decade have turned early adopters into millionaires and billionaires. The scarcity of Bitcoin, remember there will only ever be 21 million Bitcoins in existence, can drive up its value over time. Plus, as more and more businesses and institutions accept Bitcoin, it's becoming an increasingly mainstream asset. But let's not forget, high reward often comes with high risk. Bitcoin's price is notoriously volatile. Remember the peak in late 2017, followed by a sharp crash? Or the roller coaster ride we saw in 2020? Bitcoin is a highly speculative asset, and its future is anything but certain. Moreover, while Bitcoin is decentralized and free from government control, this doesn't make it immune to regulatory risks. Governments around the world are still figuring out how to deal with cryptocurrencies, and any future regulations could significantly impact Bitcoin's value. And then there's the environmental argument. Bitcoin mining consumes a huge amount of energy, which contributes to climate change. As we become more conscious of our environmental footprint, this could become a significant factor for potential investors. So, circling back to our original question, is Bitcoin a good long-term investment? Well, it's not a straightforward yes or no answer. It really depends on your personal investment goals and risk tolerance. If you're the adventurous type, willing to ride the waves of volatility for potentially high returns, then Bitcoin might just be your game. But if you're a conservative investor seeking steady growth and stability, Bitcoin might be a bit too wild for your taste. The answer isn't black and white. It all comes down to your investment goals and risk tolerance. Let's recap what we've learned today. We've journeyed through the intriguing world of Bitcoin, a digital asset that has captured the attention of investors, tech enthusiasts, and financial institutions alike. It's a unique entity, one that operates outside the traditional financial system, is decentralized, and is built on a foundation of complex, yet fascinating blockchain technology. We've also explored the potential of Bitcoin. As a store of value, it's often compared to gold, earning the moniker digital gold. It's a potential hedge against inflation, and its scarcity, with only 21 million coins ever to be mined, adds to its allure. Furthermore, its use in transactions, especially cross-border ones, offers a level of convenience and speed traditional banking channels often can't match. But it's not all sunshine and rainbows. We've discussed the risks associated with Bitcoin investment. The price volatility is notorious, with significant price swings not uncommon. There's also the risk of regulatory changes as governments around the world grapple with how to manage and oversee this new form of currency. And let's not forget about the technological risks. The world of cryptography is complex, and security breaches, while rare, can have significant consequences. We've deliberated on whether Bitcoin is a good long-term investment. While some see it as a golden opportunity, others view it as a risky gamble. It's a debate that continues to rage on, and the answer isn't black and white. It depends on factors such as your risk tolerance, investment goals, and understanding of the cryptocurrency market. Ultimately, whether or not Bitcoin is a good long-term investment is a decision you'll have to make for yourself. But with the right knowledge and understanding, you'll be well equipped to make that decision.